In this session, we will be discussing IFRS 15, Revenue from Contract with Customers. Revenue is an important source of information or a performance metrics from an investor's perspective. There are 5 steps to recognize the revenue. We will be discussing each one of them in detail. The first step is to identify a contract. So, determine the existence of a contract with the customer. To identify a contract, there are certain criteria. So, which are these criteria? So, IFRS 15 tells us that a contract is an agreement between two parties that creates rights and obligations, and it need not be a written contract. So, the criteria for recognizing the contract are: first, it has to be approved by both the parties. Second, there has to be identifiable payment terms. Third, there has to be a commercial substance, that is, the contract must have economic significance. And lastly, probability of payment. It must be likely that the payment will be received. To give you an example, suppose the ABC delivers goods to a customer and the payment terms are that he will receive the amount of consideration after 6 months. But before the 6 months are completed, because of certain economic downfall, it is difficult to recover that amount from the customer. In that case, the contract will not be recognized and neither will you be able to recognize the revenue. The next step is to identify the separate performance obligations within the contract. So the performance obligations are the promises to transfer distinct goods or services to a customer. A contract may include either a single performance obligation or multiple performance obligations. So there can be multiple performance obligations that need to be identified if the customer can use these goods or services independently or the goods and services is distinct from the main contract. For example, delivery of a machinery and the technical support to be provided for 12 months. These are 2 separate performance obligations. Third is to determine the transaction price. So IFRS 15 defines the transaction price as the amount of consideration the entity expects in exchange for satisfying the performance obligation. Please note, sales tax will be excluded from the transaction price for recognition of revenue. There are certain elements related to the transaction price. The first is the variable consideration. If there is any uncertainty related to a part of the consideration, depending on the future events, then that would be termed as a variable consideration. The variable consideration will be recognized as a revenue only when it is highly probable that the entity will receive that amount of variable consideration. Non-cash consideration. So, evaluate the impact of the non-cash item on the price. So, if you receive a non-cash consideration, the revenue will be recognized based on the fair value of the non-cash consideration. The financing impact, the financing component. For example, in determining the transaction price, the entity must consider the timing of the payment provided by the customer or the entity with the financing benefit. For example, if there is a significant difference between the cash price and the credit price that is being offered to the customer, that would indicate a financing component. Or else, if there is a significant difference between the delivery of the goods and the timing of the payment to be received, that would also indicate a financing component. So in that case, revenue will be equal to the present value of the consideration. It will be discounted using the borrowing rate of the customer. Consideration payable to the customer. Now, It will be treated as a purchase transaction if the consideration is exchanged for a distinct goods and services. So in this case, the customer would be selling certain goods and services and the entity would be payable. In that case, it would be a purchase transaction for the entity. But if the consideration is not for distinct goods and services or is a part of the contract, existing contract, then the consideration payable to the customer will be reduced from the transaction price. Lastly, allocation of the transaction price. The total transaction price should be apportioned or allocated to the different performance obligations based on the individual standalone selling prices. The best way to determine this is by actually distributing the transaction price or allocating the transaction price based on the actual selling price of the individual performance obligations. If the customer receives a discount for a basket of services or goods that are being provided, the discount will be applicable proportionately to all the performance obligations. You will recognize revenue only when the performance obligation is fulfilled. It can be done by transferring the goods to the customer. The performance obligation is satisfied at a point of time when the customer obtains control of the promised asset. An entity controls an asset if the indicators for identifying whether the control has been transferred to the customer. First, the entity gets the right to payment. The legal title has been transferred, the physical possession has been given to the customer, and the risk and rewards associated with the ownership of the asset are with the customer, and acceptance of the asset by the customer. Performance obligation satisfied over time. This has to be identified when the customer receives and uses the benefits simultaneously with the entity's performance. The asset is created or asset is enhanced for the customer or the asset is controlled by the customer. Third, the entity's performance has no alternative use and it has the right to payment. If the performance obligation is satisfied over time, the revenue is recognized over the time period based on the progress towards satisfaction. There are two ways in which the progress can be measured. First is based on the output method, that is surveys time lapsed. Second is the input method, that is the cost incurred with respect to the estimated total cost. Sale and lease back. So if you sell an asset and lease it back with a right to, or let's say with an obligation to purchase it back, then you will not recognize it as a sale but will recognize it as a financing transaction. But if the repurchase it is at a lower rate, you will recognize it as a lease. If you sell the asset and lease it back with an option of repurchasing, it will be a call option. Again, in this case, you will recognize it as a financing option and not a sale. There can be a third category where you sell the asset, lease it back, but the customer has the right to sell the asset to you. In that case, the customer will sell it to you or will enforce the right of repurchasing it only if it is economically beneficial to him. In that case, again, you will either recognize it as a sale or a lease option. If there are modifications to the contract, you will recognize it as a separate contract if the scope of the contract increases or there is an increase in the price. You will recognize it as a separate contract if by terminating the existing contract or you will add it to the original contract. Presentation in the financial position. You will recognize it as a receivable if you have the right to the consideration, or you will recognize it as a contract asset. If you have received the consideration before fulfilling the performance obligation, you will recognize it as a contract liability. Thank you.